What's good, everybody? It's your boy TFT, aka the Brainless Trader, and we are back. What we're gonna go over today is a little bit of my progress from this week, talking through just the trades that I took, what happened, and then we'll take a look at the trading journal that I have going, just taking some like simple data for me personally that's gonna help me along my journey to begin to really take payouts in the market and be very profitable. So let's get into it. First trade was GBP USD, trade on a Monday. Typically don't trade on a Monday, but this year I'm kind of excited for the opportunities that are here because there's a lot of opportunities to trade on Monday. So I mean, there will be, just because of the volatility of this year. The reason why I traded on Monday was this. Let's talk through it. Essentially, if you go to, let's just go to the daily on the DXY first. The DXY presented a good opportunity for potential bullish entry elsewhere. If you were entering on the DXY, it would have been bearish. Let's see if we can get the computer to, okay, cool. So right here, down here, we're kind of looking at volume imbalance. At the time, I think it was Monday the 8th, we were here and the volume imbalance was being respected. Price had gone up and touched the fair value gap area, and so I was interested in seeing whether or not price would really give me a push downward, which after it touched on Friday, this fair value gap area went up again and kind of respected whatever is going on in a lower time frame. So if we can go a little bit lower, we can get into what was going on the 8th. Okay, so essentially you got Friday that happened, you've got fair value gap, and if we undo this, I know we got the fair value gap here, and then on the 8th you had price respecting the consequential encroachment of the fair value gap. So you got all this underlying bias potentially presenting a situation where, at least for the 8th, the GXY would give us some sort of bearish movement. And so we got that 7 a.m., 8 a.m., got some bearish movement, and then onto kind of the rest of Monday. So at this point, you know, I'm having seen what price did at 3 a.m., and then I took that to the GBP. And so then what we have here in the GBP is an opportunity to buy. Now price had already gone and touched the fair value gap in the GBP. There's also what's a 15-minute fair value gap that we were looking at, so we'll break that down for you. Let's see. Why are we going so slow? Too many things moving at once. Okay, so here we go. Now the 15-minute fair value gap is here, and I love how, I think honestly this is because of ICT, that they're allowing us to have these rectangles automatically fill with the midpoint, because why would they do that any other time? It's never been like that in all the years that they've had it, and only this year have I noticed them add the like automatic midpoint. So helps us. So this was the 15-minute fair value gap. If you look, price basically barely taps across the midpoint and then runs back the other way. Bodies of the candles on the top of the 15-minute fair value gap. This would have been a nice entry at 3 a.m. considering the fact that we were already bullish, right? And we knew that price was pulling into an FEG. I actually had it highlighted. I recorded the trade. I didn't record my analysis earlier that morning though, so I can't prove that I highlighted this beforehand. But if you believe me, whatever. I personally know I highlighted this area and then woke up and realized, dang, I should have stayed, because I highlighted the area as price was moving down at 2 or 3 a.m. but I didn't really see anything there just yet. So I just thought maybe if price would touch this area and reject it, we'll see what happens, and it did. Then I thought, okay, what else could be presented in the market that allowed me to get an entry? And so you see there's this balanced price range right here. I didn't realize this was a balanced price range at first. What I noticed was there's this order block here. Let's get rid of this. Let's get rid of this. What I noticed was that there was this order block here. If you look at the bodies of the candles, and then give ourselves a straight line, the same thing with the bottom. So consecutive down close candles. If you go to the 30-minute, it's probably like 1 or 2 candles. Gosh, every time we switch a time frame, this thing slows itself down so much. Alright. Okay. Let's go back to the 15 now. Thank you. What I was trying to show, attempting to show at least, was simply that price had an order block here and then another order block coming down into the original order block. So what do we call that? A propulsion block. On Twitter, I put my trade and everything, highlighted exactly what happened and everything that I was looking for. So if you want to see it like a picture, you can see that on Twitter. Guess we can load that up. But essentially there was a propulsion block there. I don't want to keep annotating every single thing, so if I show the picture, maybe that'll help. Okay. So, picture here. Consequential encroachment of the propulsion block. So just keep this in mind. This is the order block original. This is the propulsion block that I've been talking about. Order block, propulsion block. If you mark it out, it gives you the consequential encroachment. Just go back to the picture because I'm not about to remark it up. Right? So the bodies of the candles on the 15-minute were right here along the consequential encroachment of the propulsion block. If we go back to what ICT says about propulsion blocks, at least for me in my notes, right? Let's go back to it. We're gonna have to go up. Propulsion block. So, propulsion block. A candle that has previously traded down into a down closed candle or bullish order block, if this is the bullish version, and takes over the role of price support for higher price movement. This is the bearish version. We won't read that. We're using the bullish version. Price should never reach further than consequential encroachment. Now, for order blocks, he calls it the mean threshold, right? Consequential encroachment is typically for FEGs. Mean threshold is for order blocks, but you get the point. It's just the midpoint. So we can stick with the terminology. The consequential encroachment or the mean threshold of the propulsion block. If price is going to respect it as a support and like burst away. So that's what we needed to happen. And so fortunately for me, I was able to post my demo trade and kind of give myself a carrot and say, hey, you are doing good. But in my actual funded account, unfortunately, I wasn't able to capitalize on like just staying in this trade. Reason being is that I choked down the stop loss too much. Now in my demo, you can obviously see that I entered here, exited, then entered one more time, exited up here. Now, what happened with that is that I basically set my stop loss to below the propulsion block, which is what I should have done in my funded account. Instead, in my funded account, I set my stop loss to below the CE, or the mean threshold of the propulsion block, which that got ran out. The bodies of the candles are the most important. Go back to the picture. The bodies of the candles never close below the consequential encroachment or the mean threshold of the propulsion block. So you really just got to be patient, and that was the lesson I learned. Yes, I was able to post my little demo trade on Twitter and say, yes, it was good progress for me, but you know, it didn't end up becoming what I wanted to become as far as an actual like profit in my funded account. So that's why I'm coming here every week, just to kind of check in, and go over these things, because maybe someone else can learn that you want to set your stop loss with enough room that it has time to, the price move has time to give you what is going to happen. And as you see, propulsion block gets traded into, you get another propulsion block here because you have this order block, this propulsion block, and then literally price runs off, gives you almost 50 pips. So I'm sitting here watching this after the fact, and I'm like, all I had to do was be patient, and set my stop loss. Like, if there's this terminology, like if you just decide that today this is the hill you want to live on. I say live, some people say hill that they want to die on, but regardless, hill that you want to live on, meaning the stop loss, you're going to set your stop loss at a point where this is enough distance to give your trade a chance to live, to breathe, but also enough distance that if you take a loss with that stop loss, it's not the end of the world. So that balance is what you have to kind of be able to maneuver and work on, essentially, to really get to where you want to go. For me, that's kind of where I'm at, and the thing that I'm trying to focus on is, okay, I've been able to diagnose this trade. I've been able to, from front to back, even with the FEG that I highlighted beforehand, able to say this is what I think is going to happen. It happens like I say it's going to happen, but the little minute details of where you set your stop loss give your trade some room. What extra confluences you should have. That the bodies of the candles didn't finish below the consequential encroachment, but you have to allow for the wicks to potentially run out any stops that people are setting their stop below the consequential encroachment of the mean threshold of the propulsion block, right? So it's like, I gotta continue to refine that and make sure that I give myself enough room to have a good trade. So that's trade number one. Still good progress for me. I put the Twitter post not to like gloat, but more so just to give myself like a, an internal, I guess that's still external, so I gotta work on that, but just to kind of still post my progress and like the fact that I still was able to have a successful price move, even though it didn't pan out the way I wanted it to. Alright, so now the second trade was yesterday, Friday. I'm recording this on a Saturday. I was able to get a nice, somewhat TGI Friday move, and I'm gonna clarify what I mean by somewhat, because TGI Friday, you typically want to be entering right after a run on liquidity, which would have been right here, buy side liquidity, but this happened before Friday. So, or actually, this happened the night of Friday, 12 a.m. open Friday, basically. Oh no, this is Thursday, 12 p.m. Thursday, right? So, like, it is still TGI Friday, because you see price then runs back into the range of the week, but it wasn't like a picture perfect TGI Friday. This is more of like a market maker sell model, first or second leg type of move, because if you can see, you've got run on liquidity, or at least run to liquidity, and you've got price kind of turning around, coming back the other way. Price moves into some structure here, presents a fair value gap, price trades into that fair value gap, then trades into, which I believe there's like a 1 hour fair value gap here. Is there? Or maybe it's 30-minute. There's something, yeah, there you go. So in the 30-minute, you can see price creates this fair value gap, trades into it once, runs the stops that it was originally traded into, right? Creates that little baby breaker within this structure. So you can't really count it as a real breaker, because it's not like a run on liquidity type of breaker, but I mean, it still is a run on its own liquidity, right? But still, price doesn't finish outside of this fair value gap. So best entry would have been right here, right at the 12 a.m. open. If you saw in the GBP trade, the trade was the trade was right there at the 12 a.m. open for that day, and I have it highlighted here by this purple. Oh, I don't even have my purple line over here. Forget the purple line, but the 12 a.m. open is right here, and so my trades were occurring like within this area, so close enough to the 12 a.m. open for me. it's close enough to say, yeah, you're right at or you're right below it for a buy. For a sell, best entry here would have been within that fair value gap that I highlighted, because it's right at the 12 a.m. open, and you're knowing that this fair value gap is not being breached, and so your entry would have been right after this candle close potentially, or just depending on the lower time frames, whatever's there, then yeah, you kind of figure that out. But I didn't enter until like the second leg of this whole thing. So we can go down to the 15 minutes, and I can kind of show a little bit more detail. So price, if you would count this as a breaker, high, low, higher, high, run on this liquidity, run on this liquidity. This is the second leg of the breaker, not the second leg of the market maker sell model, but this is the longer leg of the breaker. Price moves into the fair value gap across from this breaker, and if you have the actual lowest down close candle, it's this. If you see the wicks kind of touch the lower body, lower side of this, the close of this breaker block, right, and then runs off. So that was my entry right here. Only issue that I had with this one is that I set my stops too aggressive for, my TP too aggressive for a Friday. For a Friday, you kind of want to be setting your TP based off of the nearest liquidity. Obviously, I should have probably taken a partial, at least right here, because this is where price kind of aligns. Maybe I should have set my stop loss somewhere within here just to make sure that I grabbed it, because I knew price would at least come here, but I had set it here basically. And so as price came down and touched this line, this is an old breaker from way back, a higher time frame breaker. I should have paid attention to the fact that this low and this low are relatively equal. This low is a little bit below it. At the least, you could set it just above this low and get your TGIF Friday move, right? And so I didn't do that. And then as price was trading down here, I was thinking about clipping the trade and taking the profits. I was up 25 pips, but again, I just let it do what it was gonna do, hoping for it to give me what I wanted and run to target. So if this one ended up being a break even, whereas the other trade ended up being like a little bit like 1% loss, just because I was trying to enter so much on the other one, versus this one I had the one entry, I added a position in my funded account, but unfortunately I really wasn't able to capitalize on this. And this is really a false representative of where I exited, because I really exited break even in my funded account. I just clipped this here after having already exited my funded account. So it wasn't a terrible trade. I think this entry was, maybe it was accurate. The actual entry is where that X is. If you can see that little red X that pops up. And the actual exit was right there. So it's about the same area. Regardless, it was a break-even trade for me, and it wasn't terrible for a Friday. I was up 1,500 at one point, so I think I just wish I would have taken that profit and kind of put myself back into position. I would have regained some of the losses that I had from the GBP trade on Monday. So with that said, that's my check-in for the week. That's a lot of good progress, a lot of good learnings, and the biggest thing for me is just coming back every week, staying engaged, and just continuing to believe and continuing to put in the work so that when I'm in the market, I have the confidence and I'm taking trades with confidence, understanding the little things that I got to do to make sure that I give my trade the room to, if I'm correct, or if my trade is in the right direction, if I'm on side, then I give myself the best chance to be successful, and I can let my trade breathe and do what it's got to do. So with that said, I'm starting to get pretty good at this 20-minute thing, so I'm gonna try to keep this up. But y'all just have a blessed week. Stay at it, stay focused. Don't let anything stop you from just continuing to be who you are in the market and pushing towards your goals. I wish you the best, and we'll catch you next week. Peace.